As Australia's love affair with property continues, mortgages have driven household debt to unprecedented levels. But the days of record cheap money look to be coming to an end. Reserve Bank heads have been out in public this week, offering upbeat assessments of the economy and indicating a rate rise is well in their sights. And two of the big four banks have changed their forecasts, predicting 2 rate rises as early as next year. Speaking in Perth, the Reserve Bank Governor Philip Lowe signalled the days of rate cuts are over and said the RBA was watching closely what was happening overseas.
A rise in global interest rates has no automatic implications for us here in Australia. Notwithstanding this, an increase in global interest rates would over time be expected to flow through to us, just as the lower interest rates over recent times have.
Already saddled with record and world-beating debt, how will households cope once higher rates start to bite? To discuss, I was joined earlier in the studio by HSBC's Chief Economist, Paul Bloxham, and Principal at Digital Finance Analytics, Martin North. Paul Bloxham, Martin North, thank you for joining the business.
You're welcome.
Martin North, I might start with you. We had Governor Philip Lowe out yesterday telling borrowers that they need to prepare for higher interest rates. Do you think they're prepared?
No, I don't think they are in the round. We have many households who are well ahead with their mortgage repayments and looking pretty good, but we have about 860,000 households who are really close to the wind at the moment. In other words, their cash flow is just about covering the costs of their mortgage and everything else. So if rates start to go up, that's an issue.
Paul Bloxham, yesterday, Philip Lowe also said that we should expect the next move in interest rates to be up. And even though he doesn't expect that they're going to come anytime soon, he does say that overseas, if we see interest rates rise, that will flow on to Australian borrowers. Are we in a particularly precarious position?
Well, I think both those points are reasonable. We think the next move for interest rates is likely to be up as well. Both the global economy is recovering and the local economy is starting to pick up. That big drag we were having from falling mining investment and falling commodity prices is now in the past. And so we think overall growth will lift. You're seeing that reflected in the labour market. So employment growth has been quite strong. The unemployment rate has been edging down. And that's the thing that really the RBA has been pointing out, that the recovery is underway there. Now, usually when the labour market tightens up, and the economy starts to improve, we start to see a pickup in wages growth. It delivers a bit more household income, and that's when you see the RBA starting to lean into it by starting to lift interest rates. And that helps to deal with the fact that some households have taken on a fair bit of leverage.
Well, these people, though, that Martin refers to as sailing close to the wind, we have seen the banks independently, well, under pressure from the prudential regulators, push up interest rates as it is. That's already putting pressure on them. Aren't you concerned that those people who are sailing close to the wind could be caught short if we see global interest rates move or the RBA is forced to push rates up?
Well, it's certainly something that needs to be watched very carefully, but if you look at history, typically the RBA doesn't start to lift its cash rate until they have clear signs that inflation is picking up, I think, and the wages growth is picking up. And that comes along usually when the labour market tightens up, which is what we're already seeing.
Martin North, the RBA is aware of this as a problem. They've spoken often about the issue of the huge level of Australian debt. Surely they're not going to push rates up until they're certain that the economy can take it.
Well, the question is, have they got the time to do that, right? So if international interest rates go up, that's immediately going to have an impact on the financing costs. Our banks are heavily reliant on costing funds from overseas. That's going to put upward pressure on their need to raise rates here. So we might see some out-of-cycle stuff happening first. The second is that the Reserve Bank talks quite a lot about households, but you've got to get down into the detail to understand just how different households are. And if you wait for the end of the queue, as it were, before the income growth starts to flow right through, you're going to have to wait a really, really long time, and I'm not sure that they have that amount of time.
Paul Bloxham, we have a range of record statistics going on in the housing market at the moment. Across Australia, median house prices are now 32 times rent. We've also seen Australian dwelling stock now 7.7 times employees' income. These aren't particularly good statistics if you're concerned that maybe there is a bubble in the housing market, is it?
Well, I think the first thing you've got to do is think about Australia as a lot of different housing markets, because there's a lot of divergence across the country at the moment. Perth house prices haven't really done anything in 5 years. Brisbane house prices are up modestly, same with Adelaide. We've got a house price boom that's been going on in Sydney and in Melbourne. In those cities, you've seen very strong strong house price growth. But there are a lot of fundamental factors driving that strength in Sydney and Melbourne. They've got strong population growth. The economy is shifting to being driven by those economies. Tourism, education, the services industries are strongest in those states. The infrastructure pipeline is largest in those states as well. So there's a lot going on the demand side. And then on the supply side for those cities, although we've been building more, we still have not been building enough to keep up with that population growth in Sydney. And in Melbourne, I think in the apartment market, you have seen a lot of building, but in the detached market, there's still a lot more to build to keep up with that demand. So I think you can justify the larger part of what's been going on in Sydney and Melbourne based on those fundamental factors.
Martin North, you're shaking your head.
I don't agree with that. I think that we are at least 30% overvalued in our main markets. And, you quoted 7 or 8 times. In the UK, they're worried at 4.5 times. So we have a lot of households who are highly leveraged. Our underwriting standards have been very loose for a long time. Now, they're a little bit tighter now, but you've got a lot of households who are effectively enjoying loans they could not get now under the current standards. And you've also got the other factor of rising costs. And this is the thing that I think some people forget. A lot of households are struggling with fuel, electricity, gas bills, childcare costs, all the other costs of living. We have credit growth at 6%. We have income and CPI around 2%. That's 3 times. And it's been in that setting for a long period of time, way too long in my view. And it's time that I think we ratchet those back. We should be tightening the controls on lending now. And we should be helping people to understand more about what they're in for. For example, when I look at my surveys, very few households understand how much they'd be in for if rates went up 1 or 2%. Because whilst the banks stress test, they don't pass that on to consumers. So consumers have no idea unless they do the maths, and most don't.
Well, the thing that typically slows down the housing market, and has done in pretty much every other cycle, is the RBA starting to lift its cash rate, or the RBA starting to hint that interest rates are going to rise. That lift in interest rates actually then slows down household debt growth and starts to deal with some of the issues that we've had in terms of household debt growing faster than household incomes. Now,
but isn't that the concern, Paul? If that the RBA is forced to intervene by pushing rates up higher, you're going to catch a lot of those people who are highly leveraged and who maybe can't afford for rates to go higher. Pain is going to have to be felt by those people in order to get the housing market under control.
So the starting point is that they're not going to be lifting interest rates until you do see clear signs that household income growth is lifting. Now, one element of that is already happening. Employment growth is picking up, and it's running quite quickly at the moment. We think it'll pick up even further based on the forward partials. That's boosting household incomes already. And the other aspect of it is, as the labour market tightens up, in the past, typically what happens is wages growth starts to pick up as well, and that boosts household incomes. I don't think the RBA will be lifting interest rates until they're quite confident that you've seen a pickup in wages growth. We just think that that's going to happen a little faster than the market currently believes. We think it will happen in the early part of next year.
Buyer beware. Gentlemen, we'll have to leave it there. Martin North, Paul Bloxham, thanks for your time.
Thank you.
Thank you.